Gonna go over here to our favorite board and talk about it a little bit. So here we go. We have business lines of credit right up here at the top, and initially we're going to talk about just a couple of pinpoints or breakdowns regarding a traditional line of credit. Now, when you think about a traditional line of credit, I want you guys to know that traditional is just directly aligned with if you go to like a national bank, a PNC, a Wells Fargo, Truist, M&T Bank, a Navy Federal, right? Like these are traditional banks. Navy Federal is obviously a credit union, but those like mainstream banks, they offer lines of credit at a high scale, right? But with that being said, they also have a really demanding underwriting process. And when you think about a traditional line of credit, traditional lines of credit, as I have written down here, they are going to require 2 years of not just being in business, but they're going to require 2 years of documentation, of documented income, of documented revenue, of tax returns, of balance sheets, of profit and loss statements. Now, granted, you might find a bank here or there that may not want a balance sheet, or they may not need a P&L, right? You might find one that wants a P&L but doesn't want tax returns. You might find one that wants tax returns but doesn't care about the balance sheet. But at the end of the day, they want to see proof that you have not only just been in business, because there's a seasoning period, right? That also has a benefit when you start talking about funding, but they don't care about you just being in business for 2 years. They want to know how much revenue have you actually made within this 2 year time frame. And so the other component that you guys want to keep a lookout for is, I actually have to write it down here at the bottom for you guys, is that when you start talking about traditional business lines of credit, they oftentimes want you to be above that 680 plus threshold. And so for my entrepreneurs out there that may be struggling, perhaps your revenue is up, but right now your personal credit score is a 660, it's a 620, it's a 615. Perhaps you were at 700 and you just dropped because you had an accidental late payment and now your score is a 600. All right, now this right here would be extremely difficult to take advantage of because they have a more strenuous or rigorous underwriting process. Now, the benefit to this particular product is that going with a fintech business line of credit oftentimes gives you better terms. Jerron, what do you mean by terms specifically? By terms specifically, I mean interest rate. I mean payment structure. I mean time frame, right? And so now you are able to tap in. Now they do want more. And I always say underwriting is based on two factors. It's based on capacity and it's based on risk factor, right? Capacity. Does the bank have enough to lend? Right? If you don't have it, you can't lend it. You can only lend what you have. Secondly, talking about risk factor, right? The more risk the banks take, the heftier your burden is going to be regarding payment structure, right? If you're somebody that has a 600 credit score and your business has been doing $15,000 a month for the last year, I can take you to a bank and get you funded, but the terms on the funding are not going to be as desirable as that of a traditional line of credit. And so when you come here again, you would garner the opportunity to gain better terms. Another thing that I love about the traditional side is there are banks that, provide you with this quote unquote concept of double dipping. And double dipping simply means that you can go to a bank and they'll give you access to multiple products at one time. It's like one of the coolest things ever, right? I can go to a bank and I can gain access to, man, not only a credit card, not only a business credit card, but I can also get access to a line of credit at the same time. Now imagine that, right? We live in a world where, man, everybody is like, running away from getting their credit ran. Nobody wants to get their credit ran. We were taught that even as children, right? Whether it was by somebody that was extremely educated in credit or somebody who wasn't. Like, we just know that embedded, man, I don't want to get my credit ran. Like, I don't want anybody to just run my credit. And so with that being said, when you get the opportunity to actually go to a bank and you can walk out of the bank with a $25,000 line of credit and then a $25,000 credit card, that is like a home run. Like, that's like the greatest thing in business credit mania. Like I could go here and I can get approved for multiple products at one time. And so that's one of the benefits and the advantages that you guys will have by way of going with a traditional bank, because a traditional bank is not sequestered in a corner or boxed into a corner where they can only do mortgage loans, right? Or where they can only do auto loans, or where they can only do credit cards. Like, the reason why I say that, just to give you guys some context, obviously, I used to be in the mortgage industry, and I originated loans with a mortgage bank, a mortgage lending institution. That was the primary source of revenue for that institution. But when you look at a bank like American Express, you have a higher chance at getting approved at American Express, even if you don't have the ideal profile, because American Express is a credit card bank. That is the label of their bank. That is what they originate. That is what they produce. That is the primary source of their revenue, like that they're providing to the marketplace. And so I say that to say, when you're looking at a traditional bank has a myriad of products that they can provide. Like, I mean, it's a great litany of products that they can provide. So they have personal credit cards, business credit cards, personal lines of credit, business line of credit, mortgages. They do automotive finance loans. They do home equity lines of credit, cash out refinances. Like, they're not limited or boxed in. And so that is the benefit that you have about going with a traditional lender, because, or traditional bank, is that you can go in, and obviously you can go in, build a relationship, build an account, gain access to some of the investment products and things of that nature. But you gain access to the possibility of being able to go back and utilize, man, or get approved for multiple products at one time. So that's the thing that I love about traditional banks. They're super strong, but again, the underwriting process is thorough, right? You are 100,000% going to need a 680 plus, right? You may be able to go 650, and that's like your credit. I mean, you got a super strong situation going. You bringing in 5-6 figures a month for the last couple of months, couple of years. You got X amount of money in the account. But this 650 has to be able to be explained, right? Like, why do you have a 650? Oh, I had an accidental late payment. I got high utilization on this side, but if you bringing in enough money and you got enough activity flowing, then you can just pay that off, right? So that's what I have to say about traditional lines, man. Traditional banks, man, they're really cool.